2022 was a tough nut to crack when it came to the stocks and share market firms. As the dreaded year ended, investors are hopefully waiting for an end to their eye-watering losses too. But the real question arises, will 2023 put an end to the profit drought? Would uncertainty still hang in the air? One thing is pretty clear, that the uncertainty would surely bring up a lot of opportunities for the ones who have an eye to grab them. The investors are yet to see the prolonged effects the Russo-Ukrainian war is going to have on the market, while the huge recession is yet awaiting. Hence, without any further ado, let's dive right into the video and find out what the 2023 stock market have in the plate for rookie investors. Before the year had begun, the Federal Reserve interest rate already tightened. While the effects lingered from the Russian wars, adversely effects on the fuel rates are still on the rise. As stated by the fourth richest man on the globe, Warren Buffett, the huge incoming financial recession is inevitable. The globe could be struck by it at any moment now before 2024 begins. As we move closer towards the Great Financial Depression, big bull investors believe that there could be a hidden opportunity incoming for those who are willing to take it. In 2023, investors must be utmost careful for sector changes and thus make smart stock picks accordingly. Moreover, long-term trends and investing norms are also shifting. The Dow Jones Industrial Average for the upcoming year has downgraded to 8.8%, all thanks to its underexposure to badly beaten technology stocks. The other heavy stocks like Nasdaq has endured an ugly fall. Hence, the investors are hoping to see a challenging hike in these stocks by almost 10%. This uptrend could be caused due to pressure, while the investors who followed IBD stock market principle could have limited their losses as compared to last year. The Russian invasion of Ukraine acted as a major catalyst for a blow to the equity markets. The soaring fuel prices were responded by the Federal Reserve by aggressively raising its rates in order to tame amounts. As the Federal Reserve will try to cool down the negative effects of the recession, and inflation is set to happen. The experts believe that the first quarter of 2023 could be dry, while the second half could see a huge fall in the Dow Jones Foundation. Even though 2022 was pretty worse when it came to stock prices touching the sky, experts believe that only few of the economies were affected, while the rest are yet to go down. Moreover, the Chinese pandemic market is again about to open, which could cause a huge spike in the inflation too. The pressure for company earnings under broad belts are set to increase. Hence, the stock prices per company will again soar. As the stock prices would rise, this would eventually lessen the sales. Thus, the broad belts in companies will be highly pressurized to increase labor cost and other expenses, directly affecting the profit margin. For the new investors, big financial gurus have highly advised to invest more in value stocks than in growth stocks. Ever since the sectors has been adversely affected, the value stocks have seemed to outperform the growth stocks, which trend will continue in 2023 as well. While the technology sectors are mostly growth-based, will experience a big underperformance. The investor should not expect a waterfall-like return from, as it would be too painful for them. It has been estimated that the annual profit per stock would hardly exceed above 16%, so expecting anything above that would be a waste. To sum it up, the investors who are quick in their decisions and actions are set to outperform the others, while the rest who were eyeing for long-term investment and mammoth return would be on a dead end. Financial experts advise the rookie investors to stay away from the tech shares as much as possible until the recession passes. Wide divergence at the company level within sectors can also be accepted. The cap stocks, which are mildly undervalued, should be more favored. Infrastructural companies like Fluor and United Rentals are names that might perform well this year. Apart from that, Caterpillar, Deere, and Terex could outperform. Consumer discretionary technology and industrial stocks are the areas where new investors should focus on. Moreover, defensive areas like the consumers, staples materials, and day-to-day utility stocks can also be beneficial. The experts believe investors should rather thrash in all of their money into the stocks they will actually connect with, like healthcare, energy, and reasonably priced items. Well-priced growth company with a balance sheet liquidity and a free cash flow should be prioritized. As the year has just begun, we are yet to see how these predictions work out while preventing ourselves from making any impulsive investments right away. What do you think of these expert predictions for the upcoming financial year? Would you rather give up the tech companies all at once? Do let us know in the comment section below, and give this video a huge thumbs up if you liked it. Also, smash the red subscribe button and turn on the post notification bell to always find us in your home feed.